Private equity giant Blackstone out with the third quarter results just a short while ago. I want to tell you about the company's performance and bring in Jon Gray. He's, of course, the president and chief operating officer of the Blackstone Group. Good morning to you. There's so much to talk about both in these earnings and as we've been discussing and describing what seems like a lot driven by the world of AI and data centers, just where all of that is going. But let's walk through the earnings first, Jon.
Andrew, great to be with you. We had a heck of a quarter. We have a really simple business model. We've got to deliver for our customers. We did that. We've really leaned into digital and energy infrastructure. That has paid big dividends. When we deliver, we raise more capital. We raised $54 billion in the quarter, the fourth quarter in a row of over $50 billion. And it produces really extraordinary results for shareholders. Distributable earnings up 50%. But what's really exciting here is that we've got a cyclical updraft that's happening in the deal markets. It's going to keep all of you busy, I think, going forward. And then we have some big secular tailwinds out there in wealth, in insurance, what's happening in India and life sciences. And so as we look forward, despite all the uncertainty, we feel very optimistic.
In terms of the IPO market, in terms of sales, one of the things that, there's been less exits over the last couple of years than there had been before. Do you think that that's about to change when you talk about M&A?
Yeah, it definitely feels like things are changing. If you look at the overall M&A market in the U.S. in the third quarter, it was up 64%. The IPO market was up 100%. We've seen cost of capital come down. Obviously, the Fed cutting rates, the long end has come down, spreads have tightened. At Blackstone, we did 3 IPOs in the third quarter in India, Europe, and the United States. That hadn't happened since 2021. We announced this week an $18 billion deal with Hologic. You can feel sort of those animal spirits recovering. And deal activity, as you know, has been very muted. And this is obviously a positive for us and our investors.
You have been very optimistic about the world of AI and data centers, and you've invested heavily in that space. There's a big question right now, as you know, about whether we're living through some kind of AI bubble, and specifically whether some of the big tech companies that are running LLMs and the like that are effectively buying or leasing access to some of these data centers ultimately are going to have the money to do it, given that some of them, at least, are not profitable yet. And I'm curious how you're thinking about that.
Well, I'd say a couple things. Specifically on what we're doing in data centers, we're very focused on who our counterparty is and the length of the leases we sign. We're not building these things speculatively. These are not condos in Miami or Dubai during a boom period. We have 15 to 20-year leases with the biggest companies in the world who have market caps of $1 trillion to $4 trillion. So this to us seems like a very sensible way to play this very large investment theme. But I do think the AI, which gets a lot of bubble talk, it's worth thinking about why people are investing this much capital. We are beginning to see now some really powerful examples of productivity in coding and customer engagement on the legal side, in the content area. And if you think about what's happening, it's a huge investment boom in chips and data centers and power, which will enable this big productivity boom. And if you think about the numbers involved, labor costs globally are $60 trillion. If this technology makes companies 15% more efficient, that's $9 trillion of annual productivity gains. That means a lot of value created. That justifies a lot of this capital spent. But it's worth noting there will be misallocations of capital. There will be poor investments. We saw that with railroads, with the internet. But in aggregate, the prize here is very large. So the investment aggregately, I think, makes a ton of sense. The question is doing it in a responsible way where you're thoughtful about your investors' capital.
There's a headline running on the Financial Times right now. It says, Blackstone says era of bumper private credit returns has ended. It's got a picture of you.
Yes, I think that is a little overstated, I would say, in some respects, because what the conversation was about was what's happening in credit and returns. And what I acknowledge, of course, is that base rates and spreads have come down, and earning mid-teens returns, being a senior lender, that's going to be hard to do in this more normalized environment. But what I was quick to point out is that private credit, with its direct, basically customer model, farm-to-table model, where you go right up as investors to the borrowers, can continue to produce a premium return by knocking out a lot of origination and securitization costs. And therefore, even though the overall absolute level of returns have come down, the relative returns relative to liquid credit remain really strong. And so that's our view of the world. And that's, I think, part of the reason why you continue to see investors, both investment grade and non-investment grade, allocate to private credit.